Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, finance, and or commodities. So let's dive in there. Let's take a look at see what people are sharing, and I'll make comments as we go. If you want to follow me, it's at funding_finance. And if you want to join our community, finding-value.com. That's where I dive deeper into topics, portfolio allocation, investment strategies, individual sectors, individual companies, technical analysis, trainings, all sorts of stuff that I have on the channel. And you can see absolutely everything going back over the past 2 years of how well I have performed. You can see my buy points, which I share of all the companies I buy, and you can also see the portfolio and what is in my portfolio. I don't change my portfolio that often, but I'm more of a long-term buy and hold investor, and I really focus on entry points to nail in very good entry points. I cost average in and get very low entry points for what I hope to have or the outcome to be 10 times plus my money from those entry points. If that sounds interesting, definitely sign up. We have a coupon code LEAP, L-E-A-P. Look at the description link below. So Lobo Tigra, he says, whoa, 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 this ain't no Shadow Stats number. So Larry Summers, inflation reached 18% in 2022 using the government's previous formula. You know, the one thing that gets me a little bit confused is how gold and just precious metals in general, they haven't really moved. You can see prices at the grocery store, prices in uh, retail areas like clothes and items that you purchase. They've all gone up dramatically, and they've also shrank everything. Like toothpaste used to be monstrous back in the 90s, and now toothpaste is like carry-on size is the normal size. So yeah, we've had monster inflation. I'm very surprised that the precious metals haven't taken action. I do think that something is going on in the precious metals market. I think that maybe they're holding it down. I think Powell made a comment, or either Powell made the comment, or what was his name? Volcker made the comment about one of his things that he should have done was control gold, the price of gold. And I think that's what they're doing. But they're going to fail. The market's going to overwhelm them, and there will eventually be probably shortages of the metals at some point, and I don't know when that point is, of gold, silver, platinum, palladium, all those things out in the future. Coming down, copper. Falling copper reserves grades globally. This is going to 2016 for Katusa, and we are even lower than this. And the new grades that I've seen coming online, some of them are like 0.35% or lower. The average is like 0.35, 0.36. Like that's basically what it's showing here. And as your ore grades decline, your cost to get it out of the ground goes up exponentially. Your energy consumption grows at an exponential clip when you get under 0.4%, 0.35% ore grades. So if we're bringing on, if copper goes to $6 a pound, $7 a pound, $10 a pound, it's incentivizing people to produce more copper. Yes, it's also a a direct line to infinite energy consumption. So we're entering an age which is very interesting here, and why I'm such an energy bull, where energy is literally going to go vertical in its demand. It's going to go vertical in its demand from declining reserve grades in copper, for example, for artificial intelligence and the increased consumption from the energy used in data centers and the chips that they're making, NVIDIA chips. And we've also got declining energy return on energy invested, which means we have to grow our energy volume even more to offset the decline in energy return on energy invested. So we're entering this period where energy consumption or demand is just going to go vertical. And I just see that as the most obvious, easiest, and the most versatile way to invest. And it just seems so obvious to me. And if AI, if artificial intelligence is actually successful, and let's say it is, let's say it's really successful, all it's going to do is convert commodities and energy at a faster pace. So not only is it consuming energy in record quantities itself, it's going to convert commodities and energy together at a faster clip because it can design things faster. It can convert commodities and energy into a final product even faster. And all that requires is more energy and more commodities. And then if you have declining copper reserve grades, that just means more energy on top of it. Now, will artificial intelligence find new materials, develop new materials? Will it develop new techniques for mining? I'm sure it will do some of that. I just look at it from the consumption standpoint that the efficiency of converting all this stuff into usable products, I think will ramp dramatically. There's a lot of inefficiencies in a lot of these businesses. And really, the wealth is the commodities. The way those commodities are configured into a design doesn't really matter. The underlying wealth is the energy and the commodity itself, whether it's the metal like copper, nickel, iron ore, whatever it is. Here's Jamie Koresko. He says, and they will be swimming against the current because inflation always comes in bigger waves. Got gold or silver. In this chart, and I've seen many of these charts, some people think we're in 76, 77. Some people think that we are in the early 70s. I am proposing that we could even be earlier than this. This could be a likelihood of being here, but we could also be in the 60s still. The reason I think that is because energy kind of kicked this thing all off. And energy hit a peak in 1970. And that was peak oil in America only. Then we could grow our oil consumption, our demand could grow into oil supply of the world. I think that we are pretty close to peaking in oil itself worldwide. Now, I'm probably early. I always am. Maybe it'll be delayed. Maybe artificial intelligence will come on and do something different. It very well could. And but the credit expansion and the credit problem that we have with the United States is going to put pressure on oil. And if oil can't keep pace with that credit expansion, that is where you're going to have your problem. And I think that the inflation was caused by stimulus. And I think we've got a bigger problem coming when we hit a constraint in oil worldwide. That constraint is going to really increase the inflation rate because our GDP will be constrained by the energy provided in the world of that oil. And oil is the master commodity, it's the number one commodity. So I think we're earlier than even what they have, but this could be a legit area or earlier. But this is probably a highly likelihood of an area that is pretty good. It's either here or we're over here. We're in this big wave. And I think we've got monster moves coming in commodities and commodity equities because of the rotation of money that's going to occur in the tech bubble. The tech bubble is going to be the thing that pops. We could have a sell everything event, liquidity event, potentially, maybe. I don't know. We'll see. And then after that event, they're probably going to print money because they're going to get afraid of a slowdown. They'll lower interest rates. We're going to see a monster move in house prices because the demand is going to be unlocked from the affordability going up with the declining interest rates. And then we're going to have a lot of inflation. And if energy is constrained, It's going to be bad, guys. Here's patterns technical analysis. This is URA versus the commodity of uranium. The ratio. And I like this, the way that he's got this charted. Buy uranium stocks real cheap. Look how cheap we are in this ratio. This is also telling us that we are very early in the commodity game. We are very early. And I have charts like this in gold equities versus gold, in uranium equities versus uranium, and even a lot of the energy service companies are just off the page cheap when you price them in the underlying commodity itself. So we are at the beginning, I think, of a very big commodity bull market, and all of the equities are super cheap, which is another reason why I think we're so early. Here's Sahara. This is DBA. DBA is the agricultural ETF or ETN. So it's DBA, or the DB Agricultural Fund. Steady Eddie pushing through the second target here. Big downtrend area going from the mid-2000s. And we've broken that downtrend line. We've broken it. We're heading higher. We just broke through some resistance here recently. We're moving on up. There's a lot of ways, and you guys can't see that, of course. Sorry about that, guys. There we go. It's coming on up, and we've broken through that resistance line to the upside there. There's a lot of ways to play this. And for instance, we could play it with fertilizers or something like that, which I'm doing. If you're part of the website, you know that I like fertilizers, and that I think the agricultural commodity fund will keep going up, and fertilizers are a leveraged way to play it. So this looks great. Looks great. Here is North Star, Japanese bond yields. As I said a few years ago, the downtrend is over. Welcome to the new world. So the 10-year bond yield, you can see this thing, downtrend. We broke that. We broke another former resistance line. We broke that, did a retest. We have a line going across here. We are going higher, guys. Now, keep in mind, the dollar could go lower here at some point. We're looking for the relative strength of the yields against each other for the strength of a currency. The Japanese yen is part of the DXY, which we get measured against. So the dollar could go down as yields in Japan go up. The yen could get stronger against the dollar for a period of time. And we could also see that in other currencies. So it depends on when we cut and if they raise rates, how that all kind of plays together. But definitely looks like it's going higher. Great chart here. This is the agricultural fund from another from North Star Bad Charts. Downtrend line break. There's your breakout. We came on up. We consolidated a little bit for a while, and we're breaking out to the upside again. Huge deal. Big deal here. Why? Why is this such a big deal? One, it's going to be inflationary. Two, it's going to cost more money for buying food. And three, there's ways that we can make money from this. Fertilizers are cheap. They haven't broken out yet, and they are going to break out a monster breakout's coming, where these things really rip to the upside, I think. U.S. natural gas futures price was unchanged at $1.66 for the week ending March 15th. This looks like a bottom to me, guys. Coming on up, sold off, and you can see that the movements are getting tighter. So this move here to here is getting tighter and tighter. See how we're getting tighter? That generally indicates that we are bottoming, and that will eventually probably go sideways for a little bit. I call that the dead period, and then we'll work our way on up. It's going to take time, and it's coming. We're getting it. We're getting close. Gary says, for months, I've been saying there will come a time when gold starts to ignore the dollar. That time is probably starting. Notice that the dollar has rallied strongly over the last 10 days as it comes out of the daily cycle low. During that period, gold hasn't collapsed. It just turned sideways. This may change briefly, and I think it probably will, as gold may be starting down into its first daily cycle correction. Before I can say for sure, he says normal profit taking event. I'll need to see a little more confirmation before I can say for sure. But if so, then gold will retrace some of this rally and maybe retest the breakout before the next leg of the rally can begin. That leg should produce a sustainable breakout above 2200. Silver should rally to 27, 28-ish dollars, and GDX between 32, 33, maybe a little more. I agree. I'm starting to see a breakdown between the dollar and gold and also interest rates in gold. I also hope that we get this pullback because I want to buy some more precious metals. Fingers crossed that we get the pullback. B of A, SPX, secular bull market roadmap here. This is your secular bull. Now, there's a couple things I want to talk about here. You know these boxes here? Do you know what occurred in these boxes? Commodity bull markets did. Commodity bull market occurred in 31 when they revalued all this stuff. Commodity bull market from 66 to 1980, big commodity bull market. 2000 to 2013, big commodity bull market. They were also expansionary phase of real estate, a big one. Expansionary phase of real estate. And then you can look the distance between these two. We're going to enter another expansionary phase of real estate coming up here. And I think that's going to occur very soon. This is also another reason why I think we are so early in this commodity bull market. We might be at the end of a tech bubble, which I think we are. And then we're going to go into a big commodity bull market, which is we're at the beginning of it. That's why I still think we might be even in the 60s, potentially. And what occurred in this pullback here was that stimulus overhang money. It was a stimulus overhang. We haven't actually entered the commodity bull market yet. Although you can still make insane amounts of money in commodities because they are so cheap. And when the commodity bull market finally rips, it's going to push stocks sideways. And we're going to see one of these boxes get created sideways. And we could already be partially in the box. We just don't know it yet. Partially. We'll see. SRS Rocco says, unfortunately, the realistic free cash flow margin is much lower than $840. The top 6 gold miners, free cash flow per ounce was only $127 per ounce with a $1933 gold price versus $150 in 2019 with a $13.93 gold price. So total free cash flow per ounce or total gold production is what we're seeing here. And since the reserves are declining and costs are going up, some of their margins are getting squeezed a little bit over time. But that also makes them high-cost producers, which means they have a lot of leverage to the price move of gold if gold does get a big move. So we can see many multiples of the miners increase if we can get gold to outperform the price of oil in a lot of these inflation inputs. And I think it will. I think it will, but it's going to take some time, and I think we're at the beginning of that journey. I think we could easily see an 8-fold increase of gold price from the bottom of like $1,100 or something like that. Nat gas, I leave you with a moment of zen. The May contract since October converging on something. You can see that the moves are getting smaller and smaller, and that generally indicates a bottom soon. Energy stocks are breaking out as investors have never cared less about them. It says there's been a whiff of strength for the energy sector recently, and from our perch flows are supportive for contrarian play, one for second quarter perhaps. This is the energy sector. I love the energy sector. I think it's in a great location right now. And this is the Invesco equal weight energy ETF relative equal weight to S&P. And we're about, I think, to break to the upside. We've got billionaires Mark Zuckerberg and Sam Altman are allegedly buying large amounts of gold. What do you think that is? These tech guys don't buy gold unless there's something coming, guys. They know what's up. They know what's up. We've got support and resistance in copper futures. We're right at resistance here, trying to break through, and I think we will eventually. We've got Grady here. He says, posted recent big breakouts or breakouts happening now. Copper, gold, silver, agriculture, base metals index. We've got big bottoming patterns going on for huge lows in oil, nat gas, palladium, platinum, lumber. He's got all the ones I like. Inflation backing down, not happening. Welcome to the continued commodities bull market. Here is the OECD comparative inventory deficit is much greater than in 2011 and 2014, but Brent price is much lower, and that is really weird to me. We've got the Brent price here, which is the line, and these are our deficits that we're running. Look at the deficits we're running here. And look at the historical deficits were much smaller, and Brent price was much higher. We were up over $100. What is going on here? That is the opportunity. That is the opportunity. So the opportunity is that we're running these large deficits and we're at a cheaper price. So that's the opportunity there. Can copper get going now too? There's gold starting to rip and copper's about to rip to the upside. I do think it's about to get going, definitely. We've got new yield curve inversion, record length of 18 months. And I think that's a lot of people were stating that we're going to have a recession. Maybe that is the case. Maybe it is going to come, but we are at record length for yield curve inversion, and maybe we can extend it even way past this. We'll see. And that's what I've got for today, guys. So I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We still have a discount going on, LEAP, LEAP, 50% off the first month if you'd like to try it. And it goes to normal pricing after, or you can get a bigger discount on the yearly membership. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.